Hello and welcome to Building Tomorrow's Insurer, the podcast where we explore the future of insurance through the lens of technology and innovation. I'm your host, Nigel Fellowes-Freeman. I'm the founder and CEO of Kanopi, and we today are joined by none other than Jeff Shi. Thank you so much for joining us today. I'm super excited. Jeff is was the founder, I should say, of J&J Insurance for 13 years, so over a decade running that business, and now is the founder of the InsurTech.io podcast. And you, I'm sure, would have heard of him as he is in the top 50 of InsurTech influencers in the list pushed on LinkedIn. So Jeff, thank you so much for giving us your time, for joining us today. I'm really looking forward to the conversation.
Thank you for that introduction. It's nice to be here.
Awesome. Well, Jeff, I think it's always nice to start at the beginning. And I think so much of our careers and our lives are foundationally kind of built from where we start. And when I did some research and had a look at your history, kind of starting off in the automotive industry before kind of moving through into the InsurTech insurance sector, I should say. I'd love to start there. Can you kind of give me a sense of, how did you start? How did you get going? Kind of maybe your kind of early part of your career, and then how that kind of progressed through into founding J&J and then into the insurance industry yourself.
Yeah, so those histories are pretty much just randomly happening in my life, and I came from a very educated family where there's a lot of success. My cousins went to Harvard, Stanford, University of Maryland, and I was the only one that didn't go to college. So just trying to figure out what to do in my life. And I realized I enjoyed building things, and entrepreneurship was in my background. At the age of 18, I started a car performance shop right before the era of Fast and Furious, where we focused on building cars. And I literally went from no automotive engineering or tech background to flip it through a magazine and figure out what the trend is and build a performance shop. And then through that, I ran a car performance shop for 5 years where we did body work, suspension work, engine work, retail accessories, internet sales, e-commerce sales. Before eBay and Craigslist even existed, we were selling on e-forums, internet forums, drop ship nationwide, and then went to even international. So that was like before the internet really kicked off. That was with like dial-up internet. And then I kind of stumbled onto car sales when I sold my share of my business to my business partner at the time. Did that for 5 years and built the backbone of grit and sales and CRM background, leadership background. And it was a good stair step to the insurance world, where I opened my own agency and thrown $140,000 savings into something that I have never ever done before, bootstrap myself,
Jeff, sorry, can I jump in there? Jeff? What made you make that jump? Like, what was the obviously those pieces you just called out there, which are grit, backbone, understanding, determination, how to get things done in the first business. Kind of, what was the driver to then go, you know what, kind of starting an agency is the kind of next thing I want to do?
Yeah, that's a good one. So one day I was selling a car and whatever. I was in my office, and after I finished with my customer, my finance director came into my office and he grabbed me. He was like, "Hey, come up to my office." And I went to his office. Actually, he called me, and then I went to his office. And then I went to his office. He was like, "You remind me a lot of myself." And I always tell this story because it's funny, because him and I were the only Asian people in this whole entire dealership of 300 plus people. Because I was like, okay, I get it. And he was like, I was very successful at your age when I started in the car business 24, 25 years ago. But do you want to know what my biggest regret is? I was like, what's that? He was like, I have 3 sons. I didn't see them grow up. In the car business, we work 9 to 9, Monday to Saturday, no holidays, right? People holiday, they're off, they enjoy their family vacations, we're working. And he was like, yes, I made 200,000 plus over the years, per year, right? And back then, that was a lot of money before all the crazy inflations. So he has 3 sons he never see grow up, and he knew that I just became a father at the time, and he was trying to guide me to avoid that same mistake that he made. And when you're poor, which I grew up poor, I wasn't thinking about vacations and watching my son growing up and spending time with him. I was thinking about the next paycheck, the next rent, the next bill, and how to make 50,000 to 70,000, 70,000 to 100,000. I just happened to be really good with sales my first year and had a lot of grit, and here I am being really good at what I do, but getting advice to tell me to do something I should be looking at. And he told me real estate is really good, mortgage is really good, and insurance is really good. Choose between the three. And I said, what would you choose? And he was like, insurance have the least amount of profit out of the gate, revenues out of the gate. But if you build up your clientele, build up your book of business after 6 to 7 years, you'll be spending a lot of time with your family. You have an incredible lifestyle, and your family should never come before your money. It was easy for him to say because that's a rich person saying, we're like at least a middle class quote. If you're poor, your income is your family. But once you have a decent amount of savings and cash flow, then you are buying freedom. You make money to buy freedom. So I took his advice and chose number 3, and that's how I got in the insurance world.
Awesome. And how did you find it? How did you then find that process? Obviously, but the process of building an agency, building a portfolio, how did you approach that? Was there any specific classes of business you wrote in? Kind of what stage? Can you give us a bit of a sense of that journey?
Yeah. So I remember at the time, so for your listeners, that's not in the U.S. U.S. distribution in the 70s and 80s and 90s were mainly through agency force. There's captive agency force, which means you can sell one carrier. There's independent agency force, which you can sell multiple carriers. And I went with the name brand. Applied at State Farm, applied at Allstate, Nationwide, Progressive, and I kind of got rejected by everybody. Even though I had $140,000 savings, even though I had great sales track record, even though I built my own business, that did $10 million annual revenue a year at the age of 19. Even though all the things was on my track record, but at the end of the day, it's one person's opinion. The recruiter's opinion is, you could be the right fit, the right person in the right geolocation with the right qualification, the criteria. But if you don't meet this one recruiter's opinion, personal opinion, then you don't get through that gate. And State Farm rejected me. Nationwide rejected me. Actually, Nationwide didn't call me back. So Progressive, we had a couple meetings, and they were like, you should work for some agent for 5 years as a staff, and then build up your background and track record, and then apply again. Which, of course, I don't have that patience, And then Allstate was the one that was like, hey, you got money, you got saved that money. If you want to go get your insurance license, we're willing to give you a shot. So I became Allstate agent, and the first year was struggle, but I still won Rookie of the Year among an area that's like 5 states, among an area that was around 20 million population, 600 plus agency force. I was Rookie of the Year, and build up revenue over year, and we're growing at 200, 300% year over year, and continue to push every single dollar back into the business. I remember at my year number 7, that was at one of my best year, where we did about $4.3 million revenue, and we had a profit margin around 45, 46%.
Wow.
Not EBITDA, profit.
Yep.
EBITDA is accounting documents, but actual profit.
Mm.
And after that level of achievement, I still rented a 3-bedroom townhouse with 2 roommates and paying $1,800 monthly rent split between, two roommates.
Got it.
But that was like the mentality I had, that I need to sacrifice my own personal financial success in order to make sure the business succeed at an incredible model. And over the years, I built out 8 core model, which I'm actually in the process of writing a book. 8 core foundation pillars to build the best insurance agency.
Very cool. And Jeff, on that, maybe we can extend that a little bit because you'd have seen it through the kind of growth of your kind of agency world. Obviously, the depth of experience you have there around how to build a successful agency, and then obviously a bunch of the stuff you're doing now, obviously with the podcast and InsurTech and all those kind of things. There's a big range of thinking about channels, thinking about distribution, thinking about how the evolution of the agency, the evolution of how those businesses will perform kind of moving forwards. Have you got any view there, Jeff? Have you got any view of how you're seeing the agency model change and evolve? And then when you're kind of forecasting and thinking about this book and you want to then give advice to those Jeffs of kind of, I don't know, 15 years ago when they're starting out their agency, what kind of pieces of advice have you got now to share around how you think that model's evolved and it's going to evolve into the future?
Yeah. So if you watch the news, Southern California,
Sure thing.
right, is burning up. It's 100, like, I can't remember what's the number. I think somewhere around 120 or 180,000 acres have already been burned down. The latest number from weather or AccuWeather, based on the amount of property burned down, average value, they estimate this at $150 billion damage. And it's still not contained, right? We're just talking about property damage costs. We're not even talking about economic damage costs when we're talking about mortgage that's going to default. And, in the US, we bet on our mortgages like bets, right? So every $1 million mortgage, there's 100x amount of CDO derivatives on those bets. So if there's $1 trillion mortgage default, that's $100 trillion of economic hit. That could trigger the 2008 wave again. And so we don't even know what the fall is with the bank runs and default on banks. But let's just go back to this terrible tragedy that happened. And yesterday I did a post on my LinkedIn. If you want to go to my LinkedIn, look for Jeff Shi. 7 top auto insurance and homeowner insurance carrier in the US. The number one social media feed right now is still Facebook, right? And Instagram, TikTok, and X being second, third, fourth. But if you just look at Facebook and Instagram, all 7 US insurance carriers made 0 posts about this massive tragedy that they need to fork up billions and hundreds of billions of dollars to pay for. And it's crazy to me because storytelling is branding. Branding is recognition. Branding and recognition is trust. And insurance carriers, insurance MGAs, insurance agencies, at the end of the day, all of them are just selling one thing. It's just a thin piece of paper. I mean, it's a thin piece of air, right? It's not even paper, it's a thin piece of air. And they all failed. They all failed to communicate. And, you're not just communicating to your potential client, you're communicating to your current clients. And there's a lot of people who are in the situation who lost everything. They need to know what to do next. And then there are people who are potentially think about, what if I am in this situation? Like if they're in Arizona, if they are in Texas, then they want to know what to do next, right?
Florida.
Or Florida.
Yes.
At the end of the day, like you hear these expensive corporate titles and roles like Chief Communication Officer, Chief PR, right? VP of Communication, Director of Communication, Leader of Communication, Chief Marketing Officer. At the end of the day, they are all just one simple title. They're just storytellers. Storyteller for the brand, storyteller for the company. They should be making up a post, Facebook post, LinkedIn post, announcement that to their clients, to their insured, to their prospects, to their employees, displaced employees who don't have a home to live, like massive communication. And I think this is an art that we in the insurance industry lost. We are a $900 billion industry in the US alone that really, really bad at communication. And I think whoever building insurance agencies, the MGAs, the SaaS, the AI play of InsurTech for the future, when you get together with a room of people, that's going to be our founders, partners, senior leaderships. We need to figure out, how do we communicate? Do we communicate through Kanopi? Do we communicate through Nigel? Do we communicate through the podcast? Or do we communicate through all three? What is our message? What is our authenticity? And, that's a very big deal for the future. So that's just one. That's just brand, right? When people are trying to understand your brand. And that will mean a lot to the employees and future employees, because we all know talent is how successful you are. Every insurance company has money. But the difference between the more successful one to the average one to the worst ones are just talent. And how you communicate as a company, how you brand yourself as a culture will attract different level of talent, right? And also, like, I believe everybody should have a game plan on storytelling, how to storytell, how to do long form podcasts and short form videos. You need to be connected in the community. So, for example, if I am commercial agency, then I need to pick a niche. It's hard to be good at all things, right? So if you are niche in the roofers, contractors, then you need to be involved in their community podcast and figure out who the influencer is, figure out what the Facebook group is, what the Reddit group is, what the Patreon following is, and be super plugged in. Or if
You
you
almost.
go ahead.
No, keep going, Charles. Let me interrupt you.
Or if you let's just say you are in the commercial real estate play, with apartment complex, with HOAs, condo associations, with commercial office buildings, you need to be in the conference. You need to be plugged into all those other podcasters who are in that community, right? In that community alone, there's many, many podcasters, and you need to be plugged in. You need to be on their shows, and vice versa. You need to have your own shows and host all of them. So, because people are looking for authority or voice, people are looking for, I don't have the time to connect with 20, 30 platforms. I want to connect with 2 or 3 platforms who are the most expert at what they do and bring on the most guests, because people say, I have this much bandwidth to absorb content every single day, every single week, every single month. And you need to find yourself into that bandwidth to absorb content. Attention space. So
yeah, totally. To encompass that, obviously starts the core of creating successful agency. Then is kind of choosing a niche, become the authority, storytelling in there, which kind of creates brand, which creates authenticity, which creates a community. All of those things plug you in, I suppose. I think about it a little bit like, how do you become almost the new version of the industry magazine? Like, how are you the industry magazine for that super specific niche that everybody sees you as the thought leader, I suppose, but the authenticity is key, right? I think with storytelling, people can smell if it's not true. Like humans are really good at understanding if can smell if something's inauthentic. And so like underlying all of those things with authenticity, I think is critically important. Jeff, you spoke. We touched on there the California fires. If it's okay, we can just stay there for just a little bit, because I'm sure you've got a bunch of depth of expertise here, and this is a moving beast right now. Obviously, incredibly tragic and sad, and but stepping aside from that and then thinking it purely from an insurance standpoint.
You guys dealt with fire in Australia. right?
Yeah, so look, we do. We similar to California, Australia has a bushfire season every year. We've just had a big bushfire that's been kind of burning since the start of January. And to give you a sense of scale, I think the current one of the current bushfires is about 80,000 hectares. And so almost like 10x the size of obviously the California, but the difference, I suppose, is proximity to large population. Like obviously, these generally happen more in the rural areas of Australia. Not They obviously happen close to the city, but often these kind of scale fires are a little bit further afield. And obviously, the rural communities get impacted maybe a little bit more than what we've seen. What we've seen in Malibu, etc., which is kind of downtown and that kind of impact. And so the I suppose impact to life it's just different, I suppose. But we are very, very plugged into bushfires and how impactful they can be on communities. And so, yeah, we see that, and all of the kind of different ratings, etc., that we have here are very much the same as again it gets impacted in the US, and that's what I've got to look at from an insurance standpoint. When you look from the outside in, and you go, uh, what is going to be if we fast forward a year, 2 years, 3 years, the insurance impact in these areas in terms of are those homes, were they insured at all? Are they getting rebuilt? How do you get planning through? Are the insurers going to completely pull out? I'm kind of interested in your general perspective here, Jeff. You're plugged into this kind of the US insurance sector. So have you got any views here on obviously these may change and evolve over time as the situation changes, but I'm interested in how you're thinking about it.
So in the U.S. excess and surplus,
Mm-hmm.
we call it E&S line. Out of the $900 billion space, E&S line is $100 billion.
Mm-hmm.
What is E&S is, so for example, we have your standard and preferred insurance carrier
Mm-hmm.
where they file a rate with the state. And, it's very much cookie cutter where this zip code, this rate, that zip code, this rate, and et cetera. And based on these criteria, we can charge X, right?
Mm-hmm.
California is really hard state to do business in because the Department of Insurance doesn't want the insurer to take on a big price. So they really maintain how the pricing structure could be done. And they do not really allow insurance company to make a profit. And just go back to something that's in the news. State Farm, our biggest personal line property carrier, they not renew 70%, which I think was about 1,600 homes or something that nature. I could be mistaken on my numbers. But nobody really talked about why they did it. People thought, oh, State Farm not renew these policies because they don't want to pay for a catastrophic claim in case there's a catastrophic claim. Well, Palisade has always been in fire zones. They always been next to a bunch of trees. That hasn't changed. What changed was the state of California, where the city, the LA mayor, or whoever local jurisdiction that is, decided to suspend trees and debris removal last year. And the decision was made prior year. So once they made the decision to suspend removal of trees and debris, the decision was made by State Farm to not renew 70% of all their policies in these areas. And then the people who lost their State Farm policy, which is typical standard preferred, they have no choice to get a California state plan, which is backed by the state. Well, we know that most private enterprise run a better business model than the state government enterprise.
And does the state government have enough kind of liquidity and reserves and reinsurance to be able to kind of pay these claims out?
Last one I saw was the exposure was $23 billion, and they have somewhere around $80 million in cash.
Whoosh. Wow. Wow.
Yeah.
That's a big disparity. There's a big delta there.
So you tell me who's gonna pay the difference?
Got to be the taxpayer. Got to be the taxpayer, isn't it?
Insurance company, insured, or taxpayers? right?
Yeah, the insured can't afford it. The insurer's not going to do it, and so it's going to be the taxpayer, right?
Yeah. So I think, this is going to be a very big lesson for every single insurance carrier, whoever going forward, if they don't have access to AI image satellite, basically continuation of satellite scan processed by AI image on all the portfolio they have on hand to better mitigate their losses, new underwriting exposures, and current existing underwriting exposures. I just think that, let me put my thoughts together. So what I think is you can get more sophisticated reinsurance that can demand their MGAs, their carrier, to get more sophisticated on evaluating their portfolio on the book on all things properties. So that's going to lead to more non-renewals. Doesn't matter California, Colorado, Texas, Florida. And what's going to happen behind that is you're going to open the door to E&S. E&S is a $100 billion space that's going to go to $150 billion space. What E&S is I can charge you whatever I want and I can change it anytime I want. And basically, E&S insurance, the way to compare it for your listeners, if your State Farm is your traditional standard and preferred insurance company, think about that as a traditional bank loan. And E&S insurance is your typical cash advance short-term loan or loan sharks. They're necessary. That title doesn't sound good. Nobody want to be E&S or loan sharks because of the ugly title, but they're necessity. Somebody got to be there to provide a service, and they're the necessity to our civilization because you don't have a civilization without insurance because all things transactional, lending, title, liens, it all depends on insurance.
Jeff, is it only the US? Obviously, I know the Australian market and the UK market pretty well. But obviously, you know the US market pretty well. Let's see, in those markets, everything's dynamic. So the carrier sets the price, and they can bring in Nat Cat data and all of those components to make the price dynamic. Based on it used to be postcode, but now it's down to kind of house level in terms of underwriting data. Obviously, which is very different to what you're kind of talking to here, which is the state determining the price. And therefore it not being a market price, it being a state-driven price, which doesn't allow for that precise underwriting and therefore a market price to reflect what I don't know, if you go from a 1 in 1,000 year potential total loss to a 1 in 50 year, then there's got to be a price delta attached to that. And if that isn't the case, obviously there's an issue. And so can you see the on a policy level within the US that changing to allow for this more sophisticated underwriting and that cat data, et cetera, to be included? Or do you think that's a too big a jump and that's just not going to happen and just that ES is just going to fill the void because the legislation and the policy is not going to change?
It's a broad question. I'm trying to figure out how to best answer it. So I don't think insurance companies have that much control. At the end of the day, it come at a state level.
Yep.
Where the state allow people to build is where insurance company going to end up insuring, right? We are not the person determining where we insure, who we insure, what zone it is. Because if the state had properly upgraded all of the power lines, all the fires in 2018 might not have happened. 2018, California was facing a massive amount of wildfires, like 300 plus wildfires. And many of those was caused by really, really old 50 plus year old infrastructures from PG&E, right? And those electrical infrastructures had a lot of sparks. And those sparks created a lot of fires. Well, the same person that was in charge of PG&E, California, power grid company, became the director of water for California. The same person that was responsible for destroying California in 2018 became the person in charge of water to save California in 2024. They paid her $750,000 a year to take that role. And she wasn't prepared, right? She didn't have a reservoir with 117 million gallon of water tanks availability to fill up. That reservoir sat empty. And that was a reservoir for Palisade, the city of Palisade, and all their fire department to get water from. So when the houses start burning, they have no water. They have no water, and they didn't do the debris cleaning, the trees cleaning. It was all the moon, sun, stars aligned. So all of these things are out of insurance carriers' controls.
Control. Yeah, I get that.
Like
Jeff, I want to.
like tomorrow. So let's just go back to the big hurricane we had 3-4 months ago.
Mhm.
North Carolina and Tennessee, East Tennessee and Western North Carolina saw once in 100-year flood. They never had flood, right? These are mountain areas. But a lot of people didn't talk about that. It wasn't just a rain volume. It was also multiple failed dams. So these are water dams that hold water to service little cities and rural towns. If you look at Google, say how many dams in Virginia, how many dams in Texas, there are hundreds and thousands of dams across each state, right? They all can fail. We are a country with horrible infrastructure because we haven't updated them since the 30s, since the 40s, when we were top of the world. We spent the last 25 years fighting the global war on terror, and we didn't invest in infrastructures, right? So if you look at like a lot of the newer city where they grew population in the last 5 years, they have new infrastructure on dam. They have new infrastructure on electrical grid, electrical systems. Their insurance can be cheaper. I think insurance going forward, even in non-flood zone, non-FEMA flood zones, we should start thinking about where's the geolocation of these dams. Or how old are they? Do they have the potential of fail when we have a massive, slow-moving storm that just fill up these dams? Can they crack? Can they break? So, yeah.
Yeah, big question, isn't it? I think there's a lot to play out here, a lot to play out. And if you reflect on that and you reflect on all the changes that are required and how the insurance is going to change, obviously, when we'd like to sit and study and think about the insurance industry more broadly and kind of trends for 2025. Have you got any thoughts, Jeff, around what we're going to see with the insurance industry over the next 12 months? Obviously, I know you're at, I think you're at ITC Vegas. I'm sure you saw a bunch of stuff happening there. I'm sure AI, I understand AI is the biggest theme there is continuing to push through. And so have you got any thoughts there, Jeff, around upcoming 12 months, maybe kind of top 5 things you're thinking of seeing through 25 in the insurance industry?
I cannot speak for the world. I'll speak for the U.S.
Yeah, sure.
I think AI has been there the last 5 years,
Mm-hmm.
but the ChatGPT, how it's upgrading and changing things every day, and how Grok, Gemini, and everyone else's development is all pouring money into it. The biggest thing with AI is getting so much cheaper and so much more developer friendly. They say 2.5 million developers is working with ChatGPT alone, right? So out of those 2.5 million AI startups, what percentage are fintech? What percentage of those are InsurTech? Right? So that's question number one.
Mm-hmm.
AI cost is going to be a lot cheaper, where before it used to be only for the top 10% of public traded companies. But now mom and pop companies can have access to AI at a relatively
Yep.
cheaper price. So that's one easy softball trend predictions. And then the second trend prediction is a lot of insurance company, they work with third parties like Salesforce, like Duck Creek, Guidewire, CGI. When I was at InsurTech Connect, I had a conversation with CGI, and they are investing in the next 3 years $2.4 billion into building their AI upgrades across all their products. And then I asked them, I said, what percentage of your revenues are from insurance? They're like 37%. Don't quote me on that. I think that by my memory, that's what they said, right? They're a public traded company. Your audience can look them up. So what that means is, as they invest a 2.4 whatever amount of $1 billion into their own AI products, everybody who is now working with CGI can benefit from it. So if you are insurance carriers, software companies, MGAs, brokerage firms working with CGI, now you're getting benefit of someone else's investment. So third-party partnership is not just going to become, oh, just another software. I have 5 choices. Just another software, third party. That's going to be, that partner choice is going to be more important than ever, who you choose. And as far as the insurance standpoint, I think we're going to a more volatile situation where global finance might be more tightened because of interest rate, etc. Right? I don't see Trump lower the interest rate that much, because that happens, then our inflation is already going to go back to where it was 2 years ago.
Got it. And so we've got an AGA, we've got regulation. Have you got any views on distribution, Jeff? Agency versus broker versus embedded versus like agentic? Have you got a view on kind of channels to market and how that may evolve over this coming 12 months?
I have this conversation almost daily with some of the smartest people, and there's a lot of raters that's out there. There's a lot of systems, whether for personal line or commercial line, small commercial, middle market. They're used by agents, sold to consumers. But at what point do we see a society change where that become a direct rater to consumer? And where the agent is no longer selling a product through a rater, where the agent's purpose is just directing a funnel, directing attention, directing eyeballs to their raters, and consumer buy direct. And in the US, we call it rate call 1 versus rate call 3. And that's a rate call 3, right? I think we're very close. And right now, as we speak, a lot of people already have capabilities that's there. It's just a matter of consumer getting used to it. And with AI that's here right now, that's coming, 18 months before AI start processing personal line, commercial line products through raters, on a consistent level, and every carrier should figure out how to adapt. And if you are agency force, you have to figure out how to get in front of eyeballs of your customer base.
Yeah, it comes back a little bit.
Google, buying clicks, buying funnels, buying transfers, buying email marketing. The lead gen is a thing that if you don't figure out, then there's people out there with a whole lot of money backed by private equities and venture capital going to figure it out.
Yeah. Do you know what, Jeff? I think this is such a wonderful place to come back to, because I think that what the comment you just made there emphasizes the thing that we started on, which we started the pod talking about storytelling. We started the pod talking about community and how important brand is. And so when we talk about what we just spoke about, which is distribution, the impact that AI and agentic software and direct distribution is going to have, it becomes even more important that you are the storyteller for the people you're trying to sell to, that you are front of mind, that you have brand positioning, that you are the brand and the person that someone thinks of when they're looking to procure a service. And so I think that what you kind of just made really kind of comes full circle and highlights what you spoke about at the top of the pod, which was how important storytelling is in the market today.
Yeah. And then just, if you look at the public marketplace, average transactions between 2 million plus revenue agencies are 8 to 10 to even 12, depends on the the line that you're selling in, 8 to 12x on the EBITDA. But if you look at some of the public traded companies that went public, your Lemonade, your Goosehead, your SelectQuote, your Root, some of those trading were at 50 times EBITDA, or even no EBITDA at the time, right?
Mm. Yeah.
That's because they are betting on them figuring out this direct-to-consumer model,
Mm-hmm.
and they can transact each new business at a cheaper rate than the traditional way. It hasn't happened yet. Right now, the traditional agent model way is still a better transaction, but at some point, it's got to happen with all these technology that's coming, and these Wall Street people are betting on people like SelectQuote, Goosehead, and Lemonade of the world to figure it out. They're betting on them to figure out before the legacy brokers and the legacy carrier figure it out, and that's why they're getting the 50 times multiple on the EBITDA.
Absolutely. Absolutely. Jeff, I could talk to you absolutely all day long, but I'd like to just finish with a bit of crystal ball gazing, if that's okay with you. You've been in the insurance industry a while. You've kind of seen a bunch of change. If we were to fast forward 10 years and you and I sat down, hopefully in person, having a similar conversation about what the market looks like today, what do you think the conversation we're having is? What do you think the market and insurance sector will look like in 10 years when we're doing this podcast in 10 years' time?
Yeah. So I got a thought for you, and this
Sure.
can probably wrap it up. Ever since Fortune 500 been around, every insurance company have made their way to Fortune 500. They never left. Only one I can remember is AIG, but that was because their mortgage exposure on CDOs, right? Because they got into the betting of Wall Street versus sticking to the core business of insurance, high net worth commercial and life insurance and financial products. But if you look at like State Farm, Allstate, once they made it to Fortune 500, they never left. 10 years from now, maybe a little bit early, maybe 12 to 15 years from now, we're going to say, wow, can you believe that company left? And you're going to have two separate scenarios. You're going to have once in a lifetime apocalypse scenario like Florida, like California, that's going to squeeze a legacy insurance company so hard because of their portfolio on file. You say, okay, what about financial companies? What about health insurance company? There's apocalypse scenario that every single little company, think tank group think about that can squeeze in, could be exposure to some type of investment, right? And when these legacy companies are having that much portfolio that they're exposed to, and you add on the other side of the lack of innovation they're doing, the lack of attention to innovation because of the arrogance that we are Fortune 500 company and no insurance company ever leave Fortune 500 companies. That type of mentality is very toxic. And I see it. And maybe 10 years from today, 12 years from today, that we would talk about our first case studies.
There's Fortune 500 leaving. Well, I think that what that does do is where there's downfall of some incumbents, there's opportunity for others, and I think that's obviously the flip side of it, right? Which is if there's margin erosion for some of those large Fortune 500 folks, there's margin gain for others, and I think that's where kind of we play. I know that's where kind of you focusing a bunch of energy, and I think that's when we look eyes wide open on the opportunities that are in front of us and why. I think being in this industry and trying to grow the market at this time is so exciting.
Yeah, it is a exciting and fun ride the next 10 years.
That's for sure. Jeff, look, thank you so much for your time today. It's been wonderful. The conversation's been engaging. I know that there's a lot of change. We're obviously in real-time scenario with the fires in California right now. So obviously all of our thoughts with all of those folks, and hope everything kind of gets under control, and everyone kind of gets out of it safe and well. And so, Jeff, thank you so much for your time today. It's been wonderful. I really appreciate the time, and I'm looking forward to continuing, as I have done, following your content with InsurTech.io and all the content storytelling you're putting out.
Thank you very much, Nigel. Thanks for having me on.